Welcome to RBC's Markets in Motion podcast, recorded July 27th, 2026. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know: first, the stats for 2Q26 reporting season have continued to come in mixed, arguing for selectivity rather than a leadership rotation in our view. Second, last week's earnings commentary from S&P 500 companies reiterated the themes of resiliency and AI tailwinds, but didn't give us much insight into how to think about recent war developments. Third, we review how we're thinking about the role of the retail investor in today's U.S. equity market, which differs in some respects from the past, and how we're monitoring risks on this front. Fourth, other things that jump out in our updates this week include the return of S&P 500 semis and semi-equipment valuations to average levels and the bright spots we're seeing in our quant work on Japan. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. The stats for 2Q26 reporting season have continued to come in mixed, arguing for selectivity rather than a leadership rotation in our view. One thing that continues to jump out at us is our work showing that the percent of S&P 500 companies beating consensus on EPS forecasts is up versus last quarter, but that the beat rate has fallen on revenues. This supports the idea companies are doing a good job managing through a tricky macro backdrop, but that they've still been impacted by it in some ways they simply can't escape. Meanwhile, the rate of upward EPS estimate revisions for the S&P 500, its top market cap names, the rest of the index, AI, non-AI, and the Russell 2000, they're all still trending lower. This points to a slower pace of upgrades to earnings forecasts, not outright downward revisions. We continue to see strong rates of upward EPS estimate revisions for tech as a whole and semis specifically, industrials and financials as well. On the latter two, a positive tone has stuck out across the companies we've read earnings call transcripts for. Zooming out, the 2Q26 EPS growth rate in percentage terms for the S&P 500 has now moved up to 27%. Still a bit of deceleration from 1Q26's growth rate of 30%, but up meaningfully from the start of reporting season when it was near 23%. Financials has shown the biggest move up on this stat since mid-June, with energy, tech, and industrials not too far behind. Financials and industrials are still posting growth rates a bit below the broad market, while tech and energy are tracking well above the broad market. Our valuation analysis continues to suggest industrials is quite expensive, while financials and tech valuations look reasonable and energy looks cheap. Moving on to takeaway number two. Last week's earnings commentary from S&P 500 companies reiterated the themes of resiliency and AI tailwinds, but didn't give us much insight into how to think about recent war developments. On the consumer, one card company talked about how some impacts have been seen from higher gas prices, but not a general slowdown in spend. We think that's a good summary of what we've read so far across this reporting season. Some apprehension on big ticket purchases was also noted by another company. On AI, we're trying to stay focused on things that are incremental to the conversation. In that context, a couple of insurance companies stood out to us positively last week in discussions about how AI can help their businesses broadly. On the war, one of the rails did note it had seen some customers pulling forward plastics inventories, a sentiment echoed by a chemicals company. One company also talked about how if oil stays below $100, it's manageable, but may be more problematic if it goes to 110 or 120 for a prolonged period of time. Going forward, we frankly need to see more candor like this from companies, and also need to see sell-side analysts doing a better job of pressing on this issue in Q&A. Next, takeaway number three, how we're thinking about the role of the retail investor in today's U.S. equity market, which differs in some respects from the past, and how we're monitoring risks on this front in terms of data. One of the retail brokerages discussed in their earnings call last week how the retail investor has changed. They said, and I quote, "As recently as a decade ago, investing skewed towards higher income, older college-educated households. Today, stock ownership is at the highest levels we've seen in nearly 20 years. People are investing earlier in their life, and we're seeing engagement across a broader income and education spectrum." They then went on to talk about how interesting things going on in financial markets are keeping the retail investor engaged. On the data side, we're watching three things. First, FINRA margin debt, which has climbed and is high, but moves coincidentally with the stock market. Second, household stakes in U.S. equities as a percent of financial assets as tracked by the Fed. This has also been hitting new highs, but often tracks inflation. And third, optimism on the stock market in the Conference Board survey, which hit a new high in the fall of 2024 and has been in an elevated range ever since. We think it's fair to view froth in the retail part of the U.S. equity market as a risk factor to keep a very close eye on. But we would be more spooked by a degradation in trends than high levels on their own, given the dynamics the retail brokerage firm discussed in their earnings call. And let's wrap up quickly with takeaway number 4. Other things that jump out in our updates this week. The first of these is semi equipment valuations. As we've highlighted our work on the Russell 3000 and semi equipment median forward PE to investors in recent weeks, a number of clients have told us they thought these stocks had gotten even cheaper than our work was suggesting. With this in mind, we reran our analysis on the S&P 500 version of the industry and used daily pricing. The adjustment revealed that our clients' instincts were correct, as the S&P 500 version of the semis PE recently got quite close to 5 and 35-year averages. A break below these levels was also briefly seen in the late March 2026 timeframe around the broader market low. The second of the other things that jumped out this week is the bright spots we're seeing in our quant work on Japan, specifically positive flows, attractive valuations, and earnings revision trends that are moving up. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.